What if your power bill was negative and paid you Bitcoin every single day? Stick around for 7 minutes and I'll reveal three passive incomes mining play starting at just $5,000, including the flare gas stack and what helps us still net a 20% yield on our Bitcoin, even when the price crashes. So stick around. As you guys already know, Bitcoin is up 60% this year alone. But spinning up an ASIC mining farm feels like launching a space shuttle. I know, I've been there. Power contracts, firmware flashes, heat, repairs, we've done it all. The good news is that you can still outsource the headache, yet still stack Bitcoins in your own wallet. Passive does not mean risk-free, so definitely do your own research. This is not financial advice, obviously. I'm here just speaking of my experience and what we've been through in order to finally get it right. All right, so turnkey hosting is basically Airbnb for ASICs, right? I mean, think about it. You still own a mining machine, but a professional facility supplies the rack, the space, cheap power, and 24/7 room service for heat, noise, and firmware. Think of it as sending your miner to a five-star hotel where you just collect Bitcoin. That's the analogy I'd like to use. Airbnb for ASICs. It kind of works, right? Or, hey, you could drop about $5,000 on a couple What's miners, M30S. They hash for about 100 terahash. The host installs it, they power it, they take care of all the firmware and management, and you pay 4 to 5 cents per kilowatt hour on the power cost as well as the management of that mining ASIC. At today's hash price, which is $60 per petahash per second per day, that M30 machine, which you can buy for $200, can earn you approximately $6 a day in revenue. And after paying the 4 cents per kilowatt hour, you are at about $3 per day of profit after the power cost. So we went that route because we have cheap power expenditure that allows us to run older machines and we remain profitable with lower capex and lower OPEX. So CapEx is capital expenditure, OPEX is operational costs. That's the advantage of mining Bitcoin in Africa, right? It's all about where you want to mine Bitcoin at the end of the day, right? You don't have to mine it in Canada, you don't have to mine it in the US. You can be as decentralized as you want and mine Bitcoin where it pretty much rewards you the best. And in this case, it is emerging markets like Africa. Because containers run on stranded flare gas, our power costs floats downwards, right? Let me just explain this concept. Operators just need the gas. I'm talking about oil and gas operators. They just need the gas mitigated, right? If Bitcoin drops, the electricity actually gets cheaper. So it's not necessarily about the market, it's more about the power that we're consuming to mine Bitcoin and to sell it on the market. So the break even falls and we can mine profitably through any bear market. Should there be any coming, I don't know, in the next year or so, we never know, right? So this is the best move for a Bitcoin miner who wants to start but doesn't know where to and how. It would be to go to emerging markets where cost of power is very low. Therefore, you can be profitable even with lower hash rate machines. No infrastructure, no hardware. You can just buy hash rate as a service. Three main marketplaces such as Binance, Luxor, and NiceHash. But let's just focus on two scenarios, Binance and Luxor. Picture this. You got two friends, Ben and Leo, each with a different comfort zone, and they have the same goal. Earn Bitcoin without ever touching an ASIC machine. You can rent hash power online the same way you can stream a movie. Pay for what you use. Cancel when you're done, right? So let me present to you two scenarios with two different investor types. You got Ben, the Binance guy. Investments, let's say he wants to wire $1,000 from his bank account to Binance. He buys a 100 terahash contract for 180 days And that cloud mining plan will cost him $980 upfront. And he agrees to a power fee of $5, which is auto debited from his Binance account. How he earns: every 24 hours, Binance credits his funding wallet with the BTC that his contract produced, already converted from the pool rewards. At today's hash price, the revenue is about $6 a day. Therefore, he's able to clear $1 a day over 180 days. That's $189 in profit, which gives him approximately 19 to 20% return on investment while never leaving the Binance app. That's a way to do it, right? It's easy, it's zero setup. You toggle auto reinvest if you want to compound. That's the Binance way. But the risk, the funds stay inside of Binance custody, and Binance can tweak the fees. So definitely look at that risk as having an exposure to the Binance platform. You got now Leo, which is a Luxor forward type of guy. He bids in a Luxor Hashrate contract for a forward auction, winning 1 petahash per second for 90 days, costing $5,200 all in. Start date is next Monday. From day one, he contracted his hash to his own Luxor pool account, paying out BTC daily. He nets a revenue of $60 per day. All in cost is approximately $57 per day. So he gets to pocket about $3 a day. Leo could resell that contract on Luxor's secondary market if he needs liquidity. So the risk here is that the FOMO can push the prices up if people want to get on the auction quickly. And you can also, set up a max bid linked to the hash price. Like, that's all the tools and customization that Luxor platform offers if you are willing to trade their forward contract. So it is a hands-off method to mine Bitcoin. You could do like a Binance plan and forget it. And if you want, you could use that contract and hold on to it until another miner wants to buy the futures contract, just like it is for hash power. Each path is still mining math. Pay for hash, hash earns BTC, keep the spread. The key is matching your risk, tolerance, and attention span. That's what you can do if you're interested in hands-off mining. The pros is that there's no hardware failure, and the cons, well, you have to prepay everything and you have a platform risk. Now let's go back to hosting. Hosting means you own the rig, you own the actual mining machine. Contracts let you rent hash power, and ETFs, well, they let you get Wall Street exposure. So you have to pick the lane that matches your budget and sleep level, I guess. So if you are comfortable with the stock market, mining equities give you hash rate upside without a single hash board. Here are the top 5 operational hash rate in mid-2025. Number 1, you have Marathon Digital. They have a lot of deployed hash rate, they have cheap power costs, and they're targeting 50 exahash by the end of the year. The risk, though, is the company is actively tapping the open market to raise cash by issuing new shares day after day. So there's dilution risk with that one. Number 2, you got CleanSpark. They have 25 exahash and it converts Bitcoin monthly to fund the operations. They have an immersion cooled facility and they have higher efficiency. So their risk is that they're aggressive on the capex, and that could actually stretch the balance sheet for you to figure it out. Number 3, you got Riot Platforms, which they have 21 exahash and a massive facility in Texas. They're making money with curtailment credits and non-mining revenue. So they have legal contracts that allow them to make money off of their power if they're using it or if they're not using it. So other than that, the risk would be all the legality around Texas's grids and the fees associated to that. So definitely pay attention to that. You got Cypher Mining. They have 12 exahash. They're hydro-powered site in Washington State and in Texas. They have the lowest debt ratio among all the other miners. So the risk would be just the revenue concentration is based on very specific sites. So they have a few number of sites. You also have BitDeer Technologies. They have 10 exahash plus hosting revenue. They actually have their own Bitcoin ASICs. It's actually pretty cool that they were able to go out there and build their own mining ASICs. but they have China risk exposure and regulatory eyebrows. So you got to make sure you place your bets really carefully around that. They can outperform Bitcoin. Operating leverage and revenue soars while costs stay flat. That is actually a great way to make money. A general rule of thumb though, if Bitcoin hits 100%, these minor stocks can hit 300 to 500%, but they drop just as much or just as fast, even higher. So they trade like high beta tech stocks, not like bonds. So for everything that I've just discussed, the entry cost would be lowest with contracts, right? The Hashrate contracts. Here's the main takeaway. Even if most people cannot afford or have the capital to build and run their own data centers, owning infrastructure that keeps minting Bitcoin is the long-term move. An income producing asset that keeps paying dividends well into the future. Want more mining off-grid intel? Join my free newsletter at energythebtc.com. One value-packed email every other Wednesday, zero spam. Comment hosting, contracts, or ETF. Let me know which path feels right, and then we'll jump in with the answers. If this video saves you hours of research, hit like, subscribe, and let's go into next week's deep dive.